The economic picture is right now pretty annoyingly still not clear. We don't even know if interest rates are going to keep climbing or if they'll finally start to stabilize. We don't know if inflation's going to fade or flare up once again. And with so many moving parts, we don't know which real estate markets will emerge as true winners or losers in the next couple of years. So today, we're going to tackle these questions head on because every shift in the economy directly impacts you as an investor, and we want you to know what's going on as quickly as it happens. Hey everyone, it's Dave. Welcome to On the Market. Today I'm sitting down with special guest who's a repeat favorite here on the show. It's Rick Sharga. Rick is the founder of CJ Patrick Company and has decades of experience analyzing the real estate market. And today we're going to be diving into the big economic questions looming over us in 2025. Of course, we want to know what these things mean for us as investors, and we're going to talk about some of the latest research Rick has been doing at CJ Patrick about how investors, generally people like you and me, are feeling about the housing market. Let's get started. Rick Sharga, welcome back to On the Market. Thanks for being here again.
Always great to have these conversations, Dave. Thanks for having me.
Yeah, I'm excited because I think everyone who's listened to this show knows my opinions about the housing market and probably tired of hearing me blab on about it. So it's good to have a more professional person give us their opinions, and you are the right man for the job. So tell us a little bit, just how are you feeling in the beginning of 2025? How would you describe the current state of real estate investing or the housing market in general?
Well, I think it'd be premature to say I'm optimistic, but I do think the worst is behind us. I think after selling 6 million existing houses in 2021 and 5 million in 2022 and then 4 million in 2023 and again in 2024, it does feel to me like the market is kind of bottomed out. And there's some data that supports that. So it does sort of feel like we're going to begin crawling back out of the hole that we've dug over the last couple of years. And I do have a sense that things are going to be more positive in 2025 than they were last year.
I'm with you on that one. The data does seem to back that up. Mm-hmm. I'm curious though, when you talk about positivity, are there any specific metrics or areas that you're particularly feeling might start to turn around?
Yeah, well, the easiest one to talk about is inventory. We have a lot more to buy, a lot more to choose from than we've had over the last couple of years. Even though if you look at weekly inventory numbers, they're a little bit down week over week. They're still up about 24% from a year ago. And if you look at the trend over the last year, if we keep seeing inventory increase at the rate it's been increasing over the last 12 to 18 months, we should be back to pre-pandemic levels of inventory by the end of this year.
Wow, really?
Yeah, and that levels off that playing field for buyers and sellers. It becomes a much less robust seller's market, if you will, and it gives buyers an opportunity to actually do some negotiating.
That is very encouraging. I think for people who casually pay attention to the housing market or people who don't listen to shows like this or read Housing Wire, all the stuff that nerds in the housing market do, they just look at price and they say, oh, okay, has price bottomed? But at least in my opinion, I think that sort of the key to the long-term restoration of some sort of health in the housing market starts there with inventory and trying to get just people buying and selling again. Like we can't have a robust, healthy housing market at this transaction volume, at least in my mind.
Well, there's a couple things to consider there. The real shortage of homes available for sale over the last couple of years have been existing homes. It's the homes that are currently occupied. And people have decided not to sell for a variety of reasons, mostly because a lot of them couldn't afford to because they couldn't afford to double their mortgage payments. And that's what happened when the interest rates doubled back in 2022. We've also seen builders come out of hibernation. So after a full decade where they weren't building enough homes, it looks like we're going to have completed about 1.6 million homes in 2024. And anything over 1.5 million, we start to whittle away at that shortage. So this is feeling a lot better in terms of homes available to buy. And you touched on something really important, Dave. Having an ample inventory of homes available for sale slows down the competition among buyers, which then slows down home price appreciation. So most of the forecasts I've seen for home prices in 2025 show an increase of somewhere between 2.5% and 3% year over year. And that's basically the rate of inflation. So you're really talking about housing prices not going up at all this year and wage growth actually coming in at 4.5%, 5% year over year. So over time, the affordability challenge that we've been dealing with will start to at least get a little bit better, month over month and year over year.
Yeah, I'm hopeful about that. Redfin released something a day or two ago saying that in 2024, at least it didn't get worse, which I'll take at this point, right? It's like, because as you said, wages got better and prices were, I think, up even in real terms last year, but not huge amounts like we were getting used to seeing. It's gotten a little bit better. And I know as an investor or people who own current properties, you want to see your property values go up. But at least for me, someone who's trying to do this over the long term, I would rather see some years of lower growth. Yes, I would want to see my properties keep price with inflation, but I would rather see some semblance of affordability come back to the market. It's better for society, but it's also, I think, better for investors long term because you're going to be able to afford more. And again, you're going to start to see just more transactions going on, which is going to allow you to see different types of deals and hopefully better deals in the future as well.
Well, the alternatives are bad too. So if we don't see fairly long period, and I'm saying this could be 2 or 3 years where we see home price appreciation at very, very modest rates.
Yeah.
The alternative is you have home prices crash because affordability is the worst it's been in 40 years right now. And that's a combination of how high home prices got, of mortgage rates doubling a couple of years ago, and wages not keeping pace with those home price increases until recently. So we've seen this movie before, and when we've had these price shocks in the past, typically what happens is you have a 2, 3, maybe 4 year period where things just slow down. Sales volume slows a little bit. Home price appreciation slows down a little bit as the market resets. And gradually over that period of time, all of these people, or a lot of these people with those 3.5% mortgages, wind up selling their homes for one reason or another. And the market kind of reestablishes itself at a new level and you move forward from there. So, patience is probably the right buzzword right now. If you're an investor, you don't want to be chasing every deal that's out there because some of them aren't going to pencil out. And the other important thing, and I know I sound like a broken record because I think I say this every time you and I have a conversation, is the national numbers you and I talk about are good to establish a baseline, but they're not what you're going to base your investment on. You need to know what's going on in the market where you're buying, where you're selling, where you're renting. And that's what's really critical. If you're in Austin, Texas today, home prices are actually down year over year.
Yeah.
If you're in most of the Midwest and a huge chunk of the North Atlantic region, prices are going up at fairly high rates. So it really depends on where you are and what your time horizon looks like.
Yeah, that's a very good point. I think patience is the name of the game right now. There's a lot of garbage out there, but there is some good stuff to buy too. You just need to, I think it's more important than ever to really just trying, if you're an investor, to buy undervalued properties because we can't count on the appreciation, especially in real inflation adjusted terms like we would in the past. You said something, Rick, earlier I want to come back to just about the idea that the alternative is sort of prices crashing and coming down rapidly rather than this slow decline that I think we both think is more likely. With more inventory coming on, though, is there like an increasing risk that prices will go down if demand doesn't keep up?
I'm glad you mentioned that second part because we'll circle back to that demand thing in a second.
Yeah.
I think there is a chance. I would not be surprised to see prices go down marginally, but it's going to be a market by market phenomenon. If you look at prices across the country right now and what they're doing, where we have the most inventory, we have either the lowest price appreciation, or in some markets like Austin, we actually see prices down a little bit year over year, not a ton, but they are down a little bit. And I think that gives people, pause because they're not used to seeing home prices go down. It just doesn't happen that often. So I think that will be one of the factors.
Yeah.
But I don't think we're going to see so much inventory coming to market that we're going to have a huge drop off in home prices. And one of the main reasons for that is the demand that you referenced. We have the largest cohort of young adults between the ages of 25 and 34 in the history of the country. The reason that's relevant is because the median age of a home buyer, a first-time home buyer, is 35. Mm-hmm. So we've all been talking about the millennials coming to market now for what seems like the last 100 years.
Forever.
And the number of millennials hitting 35 has not yet peaked. In fact, it won't peak until next year.
Interesting.
And then it maintains a high level for a couple of years after that. And guess what? When Gen Z hits the market at that age, those numbers aren't very much lower than the millennials were.
Right.
So we have probably somewhere between 5 and 10 more years of strong demand, increasing demand. We have pent up demand from the last couple of years when millennials simply weren't able to afford to buy properties. So I don't see demand slowing down anytime soon. And honestly, all of the research I've been able to get my hands on shows that millennials and people in the Gen Z group are looking to become homeowners at every bit as high a rate as previous generations. So I don't see demand falling off a cliff anytime soon.
I don't know if you hear this, but I hear this line repeated a lot where people are like, oh, millennials don't want to buy homes or Gen Z don't want to buy homes. It's not backed by any evidence whatsoever.
That's the beauty of social media, though, Dave. You don't need any evidence. We're all experts at everything. I didn't know so many of my friends were experts on the topography of Greenland until just a couple days ago. So it's crazy. But there's no research, there's no data to support the notion that millennials and people in Gen Z don't want to buy houses. In fact, as millennials are getting older, what we're seeing is a fairly straightforward social phenomenon. We're seeing millennials really getting their first good job later, because you have to remember the first wave of millennials came out during a recession. So those jobs were hard to come by. They're getting married later. They're having kids later. And so they're buying houses later. Mm-hmm. But when they buy them, they're buying them in large numbers. And right now, millennials make up the largest group of home buyers in the country.
Yeah.
So I don't really give any credence to any of those comments.
Right. Yeah, I totally agree. And I think it's important to remember that we use this word in economics, demand, like that is a measurement of just desire. But demand is actually a measurement of desire to buy something and the ability to actually go out and buy it. And while the ability to buy homes has declined for millennials and Gen Z and pretty much everyone, all the surveys, as Rick was saying, like all of the sentiment analysis, everything that you look at shows that the desire has gone nowhere. And so it's really, my thesis has been just about affordability. As soon as affordability comes back, demand is going to come back proportionately. And although it's a small sample size, for that hot second in August when we saw mortgage rates tick down to 6%, we saw an increase in demand. And although mortgage rates are wild and volatile right now, I think the expectation is if and when they do come down, demand's going to come right back with it.
I always say there are three legs to the affordability stool, and home prices obviously are one of them. And I don't expect home prices to come down significantly in most markets in the next couple of years. Mortgage rates are another, and it's a very rate sensitive market right now. You pointed it out exactly right. August, September, mortgage rates came down to about 6%, and we saw a flurry of buying activity. I think if we get mortgage rates down below 7 in 2025, that's going to be enough to entice some people to come back into the market, and we'll see more buying activity. And I do think we'll get those rates down below 7 this year. I'm not as optimistic that we'll get to 6 or even the low 6s because of other things that are going on. The Federal Reserve is not likely to be cutting rates too much in the coming year. That kind of sets the baseline for lending. Bond market's a little bit unsettled right now. And we saw bond yields on the 10-year Treasury this year approaching 5%, which would make mortgage rates normally somewhere between 6.5% and 7.5%, just based on that metric. So they'll come down a little. But the third leg on that stool is wage growth. And we continue to see wage growth now that is outpacing both inflation and home price appreciation. And if home prices continue to settle down, or we get mortgage rates down just a little bit and wages continue to improve, at some point that affordability starts to feel a little bit better. And I think that's really the key to making all of this work.
Yeah, that makes a lot of sense. I'm with you on most of those things. So thank you for sharing with us and your more informed opinion than mine. I agree. I've been trying to caution people on this show about rates because it's easy to say, hey, the Fed has said they're going to cut rates, mortgage rates are going to go down. We've all seen in the last 6 months it doesn't work that way. No politician, even the Fed, no government entity really controls what bond traders want to do and bond investors want to do. And they have a very big say, perhaps the biggest say in where mortgage rates are going to go. And so it's worth repeating because it's so important here. We've got plenty more to discuss with Rick Sharga, including how he's seeing different markets respond to these 2025 shifts. But first, let's take a quick break. Hey investors, welcome back to On the Market. I'm here with Rick Sharga from CJ Patrick Company. Rick, I want to turn just to some of the research that you do, because you and your company, CJ Patrick, you conduct some really cool, unique investor sentiment surveys. Can you tell us a little bit first about the survey and then what you're seeing about investor sentiment these days?
Yeah, my company partnered with RCN Capital, a private lender, who actually probably deals with a lot of the folks who are watching your podcast. And we started doing a quarterly investor sentiment survey. And after we got a year of results under our belt, we created an investor sentiment index that we publish quarterly now that tracks investor sentiment across 4 different questions. Do you view the market as being better today than it was a year ago? Do you believe it'll get better than it is today over the next 6 months? How many properties are you going to buy in the next year compared to what you did last year? And what do you think is going to happen with home prices? And we throw those 4 criteria, the answers to those questions, into a magic hat, wave our wand over it, and come out with an index score. And we had 4 consecutive quarters where investors were increasingly optimistic. And then in the fourth quarter of 2024, for whatever reason, the numbers plummeted. We had a 27-point drop in the index.
Wow.
Now, some of this could be seasonal. We noticed that the score is almost identical to where we were last year this time. But I think a lot of it had to do with changing market conditions. And you and I just talked a little bit about that. So when we went into the third quarter, which was the highest positivity index we've seen so far, mortgage rates had just dropped down. So financing rates for investors had similarly started to come down. We were starting to see more buying activity. We were starting to see a little bit more energy in the housing market. And then over the course of the quarter, rates continued to rise month over month. We started to see sales slow down a little bit, which is a seasonal thing. But, margins were also starting to suffer a little bit for some flippers that we had surveyed. And so I think a lot of it had to do with changing market conditions. And I believe, I won't be able to prove this anytime soon, but I believe there's a little bit of skepticism over the changing of the guard in Washington as well. We surveyed the respondents about some of the policies that had been talked about during the campaign, and they're not all that enthused either about raising tariffs, which they think will increase their costs on repairs and renovations, or on deporting a lot of immigrants, because a huge percentage of residential construction labor is immigrant labor, and a certain percentage of that is undocumented. So there could be a little bit of reticence about some of the policies that have been talked about during the campaign. But we'll see what happens when we do the first quarter 2025 and see if the sentiment has turned around a bit.
That tracks for me. Yeah, I think a lot of people were generally thinking that once the Fed started cutting rates, it was going to be this smooth, linear path down towards better affordability and everything is going to magically get better. And I'm with you that I think the long-term trend is down, but as we've seen, it's going to be a bumpy road down. And so I can understand that people who are just hoping for a smooth ride are pretty disappointed by that. I'm surprised to hear the part about the new administration coming in, not because anything you said is wrong. I just felt like we saw a little bump in the residential market. I think the typical home buyer was starting to feel a little bit better about the economy from some of the other data. But I guess now that I think about it, people who work in construction are probably very worried about tariffs. I think that's one industry that could really get hit hard in the short term, at least, if there are big tariffs. And like you said, deportation could affect labor. So that could really impact this industry. Are these investors that you survey short-term rental investors, flippers, long-term mix?
It's a mix. We don't pick the respondents necessarily. They're kind of randomly selected.
Okay.
This particular survey, they skewed more heavily toward rental property owners.
Interesting.
And for what it's worth, in the history of the survey, we have found rental property owners tend to be a little less optimistic than flippers. I have no idea why that is, but it is a pretty consistent phenomenon.
I'm not surprised to hear that. You have to be an optimist to flip a house, right?
You actually do. You do.
If you're a little bit more risk tolerant, you have to be an optimist. I am an optimist in general, but with my investing, I'm pretty conservative. So I think I'd probably be like the rental property. I'm going to buy the solid risk adjusted returns and not shoot for anything too crazy.
And our sampling also is pretty consistent with the nature of the overall market in that it's dominated by small and mid-sized investors. We have probably 10% of our respondents that you categorize as large investors or institutional investors. But the bulk of the respondents are those small and mid-sized investors who make up the bulk of the market. By the way, I'm with you. I was a little surprised by the results. The previous survey, we'd asked them to predict who was going to win the election. Mm-hmm. And their answers skewed more toward Vice President Harris. And they also thought that Harris would create a more favorable investing environment. And just on its face, I looked at that and I thought, well, the current administration, the Biden administration, is pursuing some legislation that's decidedly unfriendly toward investors,
right.
Raising capital gains taxes, reducing tax benefits depending on how many rental properties you might own, putting a cap on the number of properties you can own as an investor. So you have all of that with the current administration, and you have another candidate whose whole career has been in real estate development, and you have to just assume it'd be a more investor friendly market, but people have their own opinions for whatever reason, and it's never a shortage of surprise when we see these answers.
That's why you got to get the data. You can't just make these assumptions. You don't know how people really feel.
One thing you might be interested in is one of the findings from the research is the challenges the investors cite are always very similar. It's high cost of financing, rising home prices, competition, lack of available inventory. But over the last couple of surveys, something that's really popped up in a meaningful way is insurance challenges.
Oh, yeah.
Both the cost of insurance and the availability or limited availability of insurance. And for about 3/4 of the people who respond, it's a factor when they're considering making a real estate investment. And about half of them claim that it's already cost them at least one deal. So it really is becoming part of the equation. And I would submit it becomes a new consideration when you're talking about affordability, both for your ability to finance a property or buy a property, or in some cases, your ability to hang on to a property as a homeowner.
Totally.
And, between rising property taxes and rising insurance premiums, people who barely qualified for a mortgage may find themselves in a bit of financial difficulty as those ancillary costs rise. And that might be an opportunity for investors to be looking at, is markets where insurance premiums are rising rapidly might be a market where you're going to have some distressed property opportunities sooner than later.
Yeah, that's a good point. We had someone on the show, I think it was back in May, I'm forgetting the name of the gentleman, but he was saying that in certain markets, I think Louisiana, Alabama were examples where taxes and insurance were equaling principal and interest on a mortgage, which is a wild thing to think about. I mean, I've been doing this for 15 years, and when I first got it started, I mean, you didn't really even think about insurance.
No.
You're just kind of like, it was like a box to check. And now it's a big thing that you really need to be thinking about. And I guess that the hard part about it, I don't really have a point here, I'm just complaining, is that you don't have any control over it. Unlike maintenance or other parts of being an investor where you can have some semblance of control, you can plan for it. Insurance costs, depending on where you live, you're kind of at the mercy of the market and the mercy of these companies. And so it does feel like a new, not just cost, but risk in the industry that I think everyone's just kind of trying to figure out what it means.
Well, I'm talking to you today from Southern California, which is experiencing some of the worst wildfires in the state's history right now in the Los Angeles area. And the estimated losses on those properties right now is somewhere between 250 and $275 billion.
Oh my God.
Now, the agencies believe that the insurance companies and the state insurance fund have the reserves to be able to cover that, but you have to know that premiums are going to go up, insurance is going to be harder to come by, and that when you have an event of that magnitude, or what we had with Hurricanes Helene and Milton on the East Coast, it's not just going to be those states where the premiums go up, because the insurance companies simply can't raise the rates high enough in those states to offset all their losses. So it gets spread around to pretty much everybody. And I think a data point I just saw was that in the last 3 years, insurance premiums for homeowners across the country have gone up by 52% over the last 3 years.
Wow.
So it's a real world issue. And to your point, it's not something we ever had to think about. Certainly not something a loan originator or a loan officer ever had to think about when writing a loan. But all of a sudden, we're talking about real money in these instances, and it's becoming more and more of an issue.
Yeah, it really is. It's something everyone needs to pay attention to. I think, I'm trying to read the tea leaves and what this all means. It's obviously a big challenge. It also makes me wonder if more people are just going to rent. I just moved back to the U.S. I was living in Europe for 5 years. I've been thinking about buying or renting. I'm going to buy, but was just like, man, do I really want to deal with this? I do it as an investor. I'm happy to keep doing it as an investor, but for my primary, I was like, maybe I'll just rent and not worry about insurance going up next year. But I think, I don't know if that's just optimistic thinking, that people are more rational, because I didn't behave rationally. The rational thing would be to rent, but I reacted emotionally and bought because I wanted to.
Well, there's short-term, long-term too, right? So if you're looking at it from a short-term perspective, it's a lot cheaper to rent than it is to own in most markets right now. And you have those unknowns like insurance premiums going up. But again, if you're renting, it's very likely your rent's going to go up every year as well.
Yeah.
If your landlord is getting socked with those unexpected insurance premiums, you know who's going to wind up paying for those too.
Yeah.
And you don't have the opportunity to build up that equity over time. So I still think for most families over the long run, home ownership is a better financial decision. Not all, but most. Again, you have to kind of get through some of this short-term, long-term mindset.
All right, time for one last quick break, but stay with us. We'll get into the best strategies investors can consider to stay ahead in 2025 right after this. Time for one last quick break, but stick with us. We'll be right back. All right, we're back. Let's jump into our final few questions here with Rick. Welcome back to On the Market. Let's jump back in. That's great advice. Do you have any other great advice for our audience of investors from all your research and surveying that you've been doing?
Yeah, I think the first time you and I ever talked, I was probably focused on the foreclosure market like 100 years ago, I think. And it feels like that right now because there's just about no foreclosure activity. So I know a lot of investors like to buy those distressed properties. In a normal market, about 1% of loans are in foreclosure at any point in time. So we would normally have 500,000, 530,000 homes in foreclosure right now. There's less than half of that. In fact, there's about a third of that in the market today. So mortgage delinquencies are at all-time lows, foreclosure activities at an all-time low, partly because everybody has a lot of equity who's a homeowner, even those homeowners in foreclosure. So once they get that notice, they're not waiting around for the foreclosure auction. They're selling their house to protect the equity they have in it rather than risk losing it to a foreclosure sale.
Yeah.
So if you're looking for those foreclosure opportunities, don't wait for the auction. Don't wait for the lender to repossess the property so you can buy it back from the bank. You're going to want to reach out to those homeowners in the early stages of foreclosure. You're probably not going to get quite as much of a discount as you're used to at an auction or at a bank-owned property sale. But you do have the opportunity to create kind of a win-win scenario where that homeowner gets to keep most of their equity and you get a property that's probably in pretty decent condition and get it for a little bit below full market value. So my advice to people who are used to buying foreclosures and looking for foreclosures is, don't wait for the auctions in 2025. Go fishing upstream.
That's very wise. Yeah. I don't know this nearly as well as you do, but when you just look at some of the data, you see that foreclosures are just so low, and it's not going to be a major contributor to housing inventory or supply in the next couple of years. But like you said, there still is going to be some distress. There's still going to be some motivated sellers, and you just have to look somewhere else to find them. I'm curious, Rick, do you think there's any risk of that changing? When I talk about these things, I often hear people say, credit card defaults are going up, credit card debt's super high, national debt is super high, we're overdue for some sort of recession, and the labor market's going to deteriorate. How do you think about the risk of some of those things happening and how they might impact the housing market?
Well, consumer debt's at an all-time high. It's at $18 trillion. But keep in mind, about $13 trillion of that, 70%, is mortgage debt.
Yes.
And that mortgage debt's offset by $35 trillion in homeowner equity. And it's mitigated by the fact that the credit of the people with those mortgages is the highest it's ever been.
Yeah.
And the economy is performing pretty well. So if we were to have an unexpected economic downturn, if we were to hit a recession and it was severe, we would absolutely see those mortgage delinquencies and those defaults go up. But that doesn't appear to be anywhere, at least on the near-term horizon. We are seeing delinquency rates go up in consumer credit. Credit card debt is at an all-time high right now, almost $1.2 trillion. Auto loan debt is at an all-time high. We saw a lot of subprime lending going on in the automotive industry during the pandemic and shortly afterwards when they were desperate to sell anything to anybody. So we're seeing a little bit of churn there. But the reality is, even though we've seen consumer delinquencies go up quarter over quarter now for, I think, 6 consecutive quarters, we're still about 30% below where we were prior to the pandemic in terms of delinquency rates.
Interesting.
Bankruptcy filings, the same thing. We've seen 2 consecutive years of growth after 5 years of declines, but we're not back to 2019 levels for consumer bankruptcies either. So really what I do see is a gradual return to pre-pandemic delinquency rates, pre-pandemic financial distress. I think it's going to take longer than that in the foreclosure market. In fact, Adam Data is in the process of releasing its 2024 foreclosure report, and foreclosure starts were down, foreclosure completions were down on a year-over-year basis, which really none of us had in our bingo cards before the beginning of 2024. So I don't think we get back to normal levels of foreclosure activity at least until 2026, if not later.
All right. Well, Rick, thank you so much for joining us today. We really appreciate you sharing all your knowledge of the housing market and your very cool, unique investor sentiment survey. Love to have you back soon to see if, some of the things you're seeing in the sentiment survey shift, or if people are going to remain somewhat pessimistic throughout 2025. Thanks again, Rick.
Thanks for having me.
And thank you all so much for joining us for this episode of On the Market. We'll see you again soon for another episode in just a couple days.